Good morning and welcome to the VSA Morning Miner. I'm Ollie O'Donnell and I'm joined by Paul Rankin. Paul, how are you today?
I'm very well, thank you. A blustery day in South London here. I'm expecting to see Winnie the Pooh or Piglet float by anytime soon here.
Yeah, it was a bit windy this morning. Right, well, today is an important day because it's the first day of trading for Tungsten West on AIM. Andrew Rack has just come back from the stock exchange for the ringing the bell ceremony, and I think it's gone to a slight premium. Mid price looked about 63.5p last time I looked, so that's good. Obviously, the story which you and Andrew have covered quite a lot of depth over the last few months, I think. They're now fully funded with an extra cushion cast with the oversubscribed and upsized fundraise. So fully funded for production restart, which we expect late next year. And we will see whether the redesign of the plant is successful, which we think it will be, and create a new British mining company.
Which is well needed, I think, in order to establish the credentials, I guess, for that the UK is back in the mining business.
Absolutely, yeah. So right at the forefront of all these issues of lack of investment in global supply chains and re-domiciling production after years of offshoring. There's a few companies up with trading updates, though. Paul, what's out there today?
Well, first off, among the big boys, Q3 production results by Anglo American. They're platinum, looking pretty good here, showing the rebound in economic activity globally, meaning more orders for raw materials from Anglo's output. Platinum Group metal operations, 39% increase in output. Kumba Iron of South Africa contributed significantly to increase in iron ore shipments as well. Primary nickel production was up 2%. And the nickel recovered out of the PGM business was increased by 20% to 6,000 tons. They did have a met coal down of 17% year on year due to some impediments in the geology with the productivity of the long wall performance from their mines there. But those tend to be volatile from quarter to quarter and end up getting resolved. They're not fundamentally flawed issues of any kind. Big number for me is the big increase in De Beers rough diamond output year on year by 33% to 24 million carats. So definitely feeding into the strong improved rough diamond prices there. They made only very modest changes to the low end of guidance on any of the output for the year that they'd previously made.
Sorry, was that bringing the low end up or down?
It's coming back. It's coming to the down from mid-range to the lower end of the range.
Oh, okay, cool. What else have we got? Bushveld and Shanta, both with Q3s. Where do you want to start?
No, I'll start with Bushveld here. That was Q3 and 9-month results there. They had an improvement of 46% in their lost time injury frequency rate, which is very nice to see. We don't, South Africa being one of the more challenged mining jurisdictions in order to over the years and decades in order to improve its injuries and death frequency in the mining sector. So good to see a nice improvement with Bushveld here in that. They had relatively steady production here on 2,629 metric tons of vanadium, which was only 2% down from previous. And the key point is that Vametco seems to be relatively steady here at this point after some hiccups earlier in the year. And they've maintained their guidance for the full year of between 3,400 and 3,600 total metric tons of vanadium. The ferrovanadium price, however, had fallen back by quite a bit during the year, and we're looking at an average for the year price so far of about $35 a kilogram across all markets.
Yeah, that's eased back since the summer. We'll see whether that's more than offsetting the cost declines and whether it's actually enough to improve the earnings in the second half. Obviously, the first half earnings were fairly weak, so it'll be a challenge to improve those significantly in falling price environment. Let's move to Shanta, Paul.
Yes, Q3 production results from the Tanzania gold producer and AIM quoted Shanta Gold. Gold production of 14,200 ounces here at cash costs of $1,063 US per ounce and all-in sustaining cost of 1,480. The average treated mill grade, I noticed, fell about 10% to 2.2 grams gold per ton at the new Luika operations, but the tons treated rose by about 10% to about 220,000 tons. So they managed to essentially maintain total gold output relatively steady there. The Singida mine construction program is on schedule at this point, and they have actually committed their first mine blast this past week. They'll build a stockpile of material at Singida while they get the mill construction underway, and that should have a mill arrival sometime in Q1 of next year, it looks like. Also nice drilling results came out during the quarter from the West Kenya project, where they're trying to prove up just shy of 1 million ounces of inferred resources at the West Kenya project into measured and inferred for mine design. So some real good high grades there they hit during the quarter, like 4 meters at 64 grams gold per ton.
Excellent. Cool. Okay. Thanks for your thoughts, Paul. You'll be back with Andrew tomorrow.
Okay, that sounds fine. Yep, we'll see you then.
Cheers.